Hello, everybody. Welcome back to a belated but not forgotten episode of the Beyond Wall Street podcast. I am your co-host, Nathan Bowers, here with Brandon Nieves. Go ahead and say hi to everybody, Brandon.
Hello, everyone. Yes, it's been a little time, but now we're back here. So, we just want to get started and give out some helpful information out to everyone.
Absolutely. Now, everybody, today we're going to be highlighting a webinar that we have going on Thursday, June 2nd, through our agency here, WH Steiner, partnership with Skyline Financial as always. And we're going to show you how to register for that webinar. If you like our podcast, like our content, and you feel like it'd be information that you don't want to miss out on, we'll show you how to do that really quick. We're going to go over to our link here. Earn 40% more retirement income without increasing your contribution. We're going to show you how to do that, all the bits, pieces, tidbits of information that you need to know what that's all about. You can scan this QR code at the bottom, and it's going to take you to mytaxfreeliving.com, where you will click register here, and you'll be able to go to Thursday the 2nd. Select 7 p.m. We have 69 spots left available. After that, we are full. And then you fill out your name, email, telephone number, and it will text you and email you out the link to the webinar there, and you will be in attendance for that. And today on the podcast, without further ado, we're going to discuss retirement plans, the accumulation and distribution phases, explain and why there's an important distinction between those two key components of a retirement plan. So at this moment, I'm going to turn you guys over to your resident subject matter expert, Brandon Nieves. Take it away, my friend.
Yeah, so when we're talking about accumulation and distribution, I always tell people there's three phases that your money goes through, or when you're trying to accumulate money. First, there's an accumulation phase, and that's the building phase. That's the phase where there's four things you got to do right? You got to know how to invest, where to invest. Then you got to rebalance your portfolio. And then you also got to make sure you got plenty of tax advantages, because a tax diversification strategy, basically what that does when you're accumulating money, is that it allows you to keep more of the returns that you're generating. Because if you're generating a 7% return, you're not really getting 7% if it's taxable. If it's tax deferred, you're simply going to pay a higher tax on an account that has been compounding. And sometimes that can take a lot of the returns that you've been generating throughout the year. Sometimes it's better to pay the taxes as you earn interest as opposed to tax deferred. It just depends on the time horizon that you spend in the accumulation phase. But the first thing when you're accumulating money, so how to invest? What's the best way to do it? So one way is a lot of people are doing this indirectly, which is called dollar cost averaging. And the other way is doing what we call a lump sum contribution. Now, which is better? Is it better for me just to dump in a lump sum of money and then just, manage that amount that I'm contributing? Or is it better for me to invest a smaller amount each and every single month? And the answer to that is, it really depends on what type of market we're in. If we're in a fluctuating market, sometimes it is better to do a lump sum investment. But the problem with that, or as I say, the challenge with lump sum investing, is that there is a lot more risk involved in that, because you're putting money in at one time. So in a very fluctuating environment, you might be able to do better at the end of the year than if you do a dollar cost averaging where you're doing it every month. But dollar cost averaging really allows you to invest without having to time the contributions that you're putting in. That's why they say it is better to put smaller amounts into an account, because what dollar cost averaging means is you're getting the best price for the shares that you're investing. So, if you got $100 and you're buying XYZ funds, and let's say the price of those shares is $10 a share, where you're getting 10 shares. If the market goes down, let's say in February, you still invest $100. It doesn't matter what the market did, but now the price of the shares went down to $5 a share. So how many shares that you get? Well, you got now 20 shares. But if the market went up the following month, and let's say the price of the shares went up to $20 a share, well, now it just means that you get 5 shares. So every time, if the market goes up, you buy less shares, the market goes down, you buy more shares. But over time, you end up getting the best price for the shares that you're investing. So the best way to invest in the market, if you don't want to be totally engaged in what the S&P is doing every day, is dollar cost averaging. So that's why that's usually recommended. The next is where to invest. So where to invest is you're looking for the optimal portfolio. Now, what is an optimal portfolio? Well, it consists of different asset classes. Different asset classes, because basically the idea is if you invest in one class, that asset is not going to be directly correlated with the other asset. So it's about finding a balance between how much you should be investing in stocks, how much you should be investing in bonds, how much you should be investing in, emerging markets. So it's finding that balance. And the way you find that balance is your risk tolerance. And risk tolerance is all about, not about your ability to, deal with a negative return. It's about how do you react when, or can you tolerate a negative return? Like if the market were to go down 20%, but you have an optimal portfolio.
It's almost there right now.
Based on, if your portfolio is optimal according to your time horizon, your risk tolerance, and what you're trying to achieve as far as, like, let's say if it's a retirement income, it doesn't matter if the market goes down today. I don't care if the market's negative today, because in the long run, the market will experience a rising tide. But accumulation, you only got one shot at getting it done right. So dollar cost averaging is how to do it as far as how you should be investing, and then looking for the optimal portfolio balance. They also call that the efficient frontier, which it's just finding that balance between asset classes, because not all asset classes move in the same direction. When stocks go up, you usually say bonds go down, bonds go up, stocks go down. That's why they tell you to put money in stocks and bonds. The problem is that when you're invested in bonds, it drags down the gains that you would have gotten had you been more invested in stocks. And right now, bonds have not been doing that well. I mean, for over 30 years, bonds have not been performing at all very well. And we also do know that when stocks go down, bonds can also go down too. So it's not that they're not even completely, totally uncorrelated with each other,
It's about just fully understanding all the different types of, baskets you can be in as far as investment wise, and what they do and how they interact with each other, all the potential aspects of the market that you're in, the behaviors, just like you're talking about, even when stocks are down, bonds can go down, understanding that, fully understand your whole financial picture when you go to create this portfolio. When, if you're a family of 4, you're not just going to have a Mustang coupe, a 401k as your only car. No, you need a minivan,
Right.
IUL, or a Roth or anything like that. You got to have diversification based off of all the different needs you're going to have.
Right, exactly. And you're not just investing for yourself either. A lot of times you're investing for a spouse. You could be investing for your kids. We also know that, healthcare is a big issue in retirement as well. So your portfolio has to play the role of a lot of different things. And you only have whatever your intended time frame is you're working with. The longer you stay in the accumulation cycle, the more money you're going to accumulate. The shorter you're in the accumulation cycle, it means that you're going to have to do one of 4 things. You're either going to have to take more risk because your time horizon is shorter. So if you want to retire, I want to retire in 8 years. Okay, well, how much you have invested now? I got 100,000. Okay, well, how much income are you looking for? Once you find out what that income number is, then as an advisor exactly how much of a nest egg they're gonna need. So if a person wants to live on, $60,000 a year, and that's what they want, well, the way to look at that is you can just take 60,000 and you know they're going to need at least $1.2 million. So if you got 1.2 million and that achieves 5% interest, that produces $60,000 a year. But then you got to also include inflation. So really 60,000, you're going to really need more like close to 85,000 because of inflation. So technically, if you want the same purchasing power that you have on what $60,000 buys you today, you're going to need most likely $1.7 million.
Even higher if you're not in the tax advantage plan too. So
exactly. You got to then the tax, because that's the other thing too that nobody ever talks about is the distribution. Because accumulation is easy. I mean, I shouldn't say it's easy, but it's a lot easier than taking money from an account. Because now this is where people get scared. They got $1.2 million, and guess what ends up happening, Nathan? They've spent a lifetime of just thinking accumulation, that now they have to start thinking distribution.
Right.
That's a different mindset, and a lot of retirees don't get to enjoy the retirement that they fully deserve because they want to leave something behind for the family, for the kids. And now they're thinking of legacy. But meanwhile, they got all this money that they have, and they're not even spending all of it because they're so afraid to lose it all, because they know I'm going to have to pay taxes. What happens if the market goes down at the wrong time? And retiring at the right moment is all about luck. Like right now, if you're going to go into retirement right now, this would be a bad moment to go into retirement. But now, after, let's say in 2023, after, let's say we've been through the trough, right? Because the market there's a business cycle. We've been in an expansionary period for over a decade now. We've hit a peak, and after the peak will come a contraction. We're now in that contractionary phase. But then the trough is when the market bottoms out. But then guess what happens after that? An expansion again. So the best time to go into retirement or distribution is when we've already gone through a bear market or a correction or a recession, because now you get to experience the gain of the upswings, but that's all luck, because you don't know at what point you're going to get to that distribution. And if you don't have a contingency strategy, you're basically exposed.
Let me just roll over some key points here before we fully transition to the distribution phase here. What Brandon's talking about is, from a cultural aspect, is you can't just, while you're in the accumulation phase and just starting off, you can't just be thinking about gaining the money. You have to think about how is it going to last or play out when I do get to that point. You need to be thinking about the full cycle of this plan as you're in the beginning of it, because you can't get to the midway point and you go, uh-oh, I have a problem. Or like you just said, if you're starting this as a retirement year, uh-oh, now we just lost 18% of $1 million, 180,000, or whatever it ends up being this year. You can't put it to a gamble. It's got to be calculated. It's got to have security to it. So you have to fully understand that, and you're not going to get that with your employer plan. You're not going to get that by just shoveling blind money into a 401k account where you have no idea where it's going or who even controls the account. You have to take the initiative in your own hands and figure out these questions and talk to someone like us who knows the questions that need to be asked, or else you're going to be flat-footed and caught out with the bathwater when it happens. Because I don't know about you, but I say this all the time to people I meet. Brandon, how many rich folks with 401ks that are retired that you know? I can't name two.
None.
Because it's not designed for the outflow of cash. It's designed for the building of cash, which is why it's a great short-term product, especially over the last 13 years where it's been phenomenal.
Yeah, exactly. I mean, every asset class has its golden year. Gold is going to have its golden year. Stocks will have its golden year. Cryptocurrency will have its golden year. Every asset class will have a golden year. Does that mean I put all my money into that asset because it had a golden year? Of course not. You have to think in terms of defensive, because what a lot of people don't know is your negative returns are going to outweigh your gains all the time. It's a mathematical certainty. If you have 200,000 and the market goes down, let's say 40%, your account value dropped to 120,000. Now, the question is, what return do you got to get the very following year to get back what you lost? 66. So think about that. The market goes down 40, you got to get 66, not even to make money, just to get back to 200,000. But let's say you had
it wouldn't be double, it wouldn't be 80%.
No, not at 40. No, at 40 would be, so now 45, it would be 82. So if the market went negative 45%, you would have to get an 82% return just to get back to where you were to break even. And then if the market went down 50, you got to get 100. But if the market went down 40, you got to get 66. If the market went down 25, you got to get 33. If the market went down 10, you got to get 11.
And I mean, either way, it could take you years to get back to where you
Well,
were.
yeah, I mean, it took people in 2008 about 5 years to get back to where they were. And what they don't realize is that, yes, you got your money back, but inflation was coming at you every single year. So you lost purchasing power. So you're not going to feel that until you get to the distribution. That's why I tell people accumulation is the drive, distribution tells the truth, because it tells the truth about how your investments were performing.
And obviously we're a huge proponent of the IUL because you talk about every product has its golden years, and IUL always has a golden year because it's good when the market's bad and it's good when the market's good.
Right. Well, I mean, look, as practitioners in this field, it's our job to do one thing. We got to make sure our clients don't run out of money. Yep. And the current financial strategy that is in place for most Americans today is what? Defer taxes into the future, maximize your 401k IRA contributions, and put your money in the stock market to get returns. Well, if you think about it, all three of those things, you are making an assumption. Everything's about assumptions. You just got to question your assumption. The first assumption you're making when you tax defer, you're assuming that you're going to be in a lower tax bracket when you go to retire. And you got to understand that when these tax deferred accounts became popular, the highest tax rate was 70%, the lowest was 14. Now the highest is 37 and the lowest is 10, but we have a debt of $32 trillion and growing. So mathematics tells you that you pay low and you defer high. In other words, if you are in a high tax environment right now, then what you do is you defer high because you're in a high environment, high tax environment. But if you're in a low tax environment currently, then what do? You pay low, pay the tax now while taxes are at their lowest point, and then that way in the future when taxes potentially can go higher, it won't affect you because your money will have already been taxed and now your money will be tax-free.
And also, it doesn't mean jack for any of you out there. And these are my favorite things I hear. Well, my company matches forward up to 45%. I'm projected to be at $4 million. That's fantastic. That doesn't mean jack when a third of it goes away to taxes, and then another, you can lose a majority of it off of a bad year in the market. Doesn't mean anything.
Yeah, and because the other thing is sequence of return risk. So like in the accumulation phase, the big risk factor is accumulating enough money and getting about at least an average market return. Like in the last 20 years, the S&P did 9.52% in the last 20 years. The Dow Jones did 0.06%. The Russell 2000 did about 9.36%, and the NASDAQ did about 10.87% in the last 20 years. Okay, so that's great, but if you go back in history, every market cycle is different. So you don't know exactly where the market's going to be at the time when you're ready to go into distribution. So let's say you're fortunate and everything went down perfect and you did great. Okay, so now you got this big sizable amount of money, but there is one big thing that you did not take into consideration, is that when you go to withdraw those funds, you're going to get hit with a negative return every single year. So you got $1 million and they earn 7%, you're going to pull out 70, but you're not going to net 70. You're going to net more like 50. So in order to get 70, you got to actually withdraw about 97,222 just to net 70.
You know, that's an interesting concept I never thought of till you just said that. If you're
Yeah.
taking, if you have $1 million and you're taking 7% out, 70,000, every year you have to at least get 7% return, or
You
you're
got to get a
losing
7%
money.
return every year, because if you do that, then you're living off the interest, right?
But
But
if you don't,
most financial planners today tell you, they call it the 4% rule. So even though it's earning 7, they're going to tell you to take out 4, because what they're doing is they're taking into consideration the market deviations, the market ups and downs, plus taxes. So they're saying, you got $1 million, take out only 4%. So you're going to take out 40,000. Even though you're getting 7, you got to take out 4. The reason why they do that is so that you have the greater probability of not running out of money, because they're taking into consideration a market drop, and they're taking into consideration different fluctuating markets. So, but that rule has been dropped down to the 3% rule. So think about that. You got $1 million, you got to take out 3, that's 30 grand, plus you pay taxes on that, whatever that tax rate's going to be. So you're going to walk away with maybe $22,000. Imagine you got $1 million and living off of $22,000 a year.
isn't that funny? This goes to that person or persons watching this video, which there's going to be at least 1 or 2 of them that go, oh, that's no big deal. My 401k, people use the 401ks and Roths for the last 50 years. Or, oh, what you have now, you're too good to be true. Like, you know what's too good to be true? The fact that you can get $1 million in an account and you can only take 3% of it, 30 grand a year to live off of, or else it completely pops like a balloon.
Yeah. And I'll tell you, and the reason why I'm going so tax-free myself is because when you live in a country where it has been the occupation of most Americans to defer, you're going to have a country where it's going to cause such a strain on all the social programs like Social Security, Medicare, that it's going to cause a ripple effect where the government is going to be forced to raise these taxes. Because what do? They take money from the younger tax-paying force to pay for the older tax-paying force. So when you have a demographic shift like that, and you got more people that are selling their shares than buying, because when most people go to retire, they take money out of their equities and they start investing in more fixed investments. That can make a very volatile market, because we're not having babies like we used to anymore. And what made this country very powerful economically is that we always had big families. Today, now the average family, we're not having kids like we used to anymore. And it's also bringing up the fact that the death rate has also been increasing in this country. So we're not producing as many taxpayers as we need based on what our based on what our outgo is. So we are headed into uncharted territories. So what I'm telling my clients is like, look, I'm an optimist, but please understand the mathematics tells us that if we're spending more money than what we're making, and then when we don't make the money that we need because our spending is so high, we go ahead and borrow money. And we've been doing that for a long time. It's at a certain point, they say that the debt is at, 32 trillion. It's really not. It's really more about 239 trillion. Because if you were to take 239 trillion, put it into an account earning treasury rates, 15 years from now, that would give us enough money to pay off all our obligations. But that would mean that we had to have 239 trillion. We don't have that. So we're really in debt $239 trillion, not the 32 trillion, because we have an accounting system in this country where we only focus on the debt, but we don't put into the accounting system the unfunded obligations like Social Security and Medicare. So when you put that on top of the debt, we're $239 trillion in debt. You tell me where taxes are going to go. And I'm telling you this right now, the Roth IRA, everybody talks about the Roth. I think the Roth is a great strategy. If your company offers a Roth 401k, do it. But please understand, it's a government-sponsored plan. You are still limited on what you can do. That's why it just so happens to be that these cash reserve insurance contracts, if it was something else, Nathan and I will be talking about that something else.
Yep.
But unfortunately, this is it. This is all we got to work with. Roth IRAs, cash reserve life insurance. That's all we got. We don't got anything else.
If you're in a traditional 401k, at
Right.
least get the Roth for the, if you will not heed our warning and trust
Get a
us
Roth.
on the insurance side of things, please, for the love of God, at least get a Roth. But
Right.
I just got the warning, so we got to start wrapping up here soon. But people, all your politics, no, it doesn't matter if you're red or blue or whatever you are. Why are you relying on the government programs to get you retired? They can change the rules at any time. We talk about how there's caps with insurance companies on our products, and people use that as a rebuttal.
Negative.
Our opposition. Well, they can change the cap at any time.
Capped on how much you can get.
And the government can switch you from a 24% tax bracket, and in 30 years you could be in a 60% tax bracket, and now you only have a third of your retirement account that's not going to taxes.
Right.
Or the Roth, they could switch the Roth, like you told me the other day.
Yeah.
Oh, it's 70% tax-free income now. You think the government's not going to do that if they default on 200 plus million, trillion, or however you want to say that, $200+ trillion in national debt, that they're not going to change the rule when they have all this retirement IRA money sitting here and they could just suck it away?
And just think about this too, Nathan. Think about this. It's a government-sponsored plan. Roth, the government created it. I mean, it's named after a congressman, Senator William Roth. It was made by a congressman.
Yep.
So think about this. If the government created it and they start seeing a migration of a lot of money being transferred into Roth accounts instead of into the traditional 401ks and IRAs, the government can start thinking, you know what? We're going to start limiting how much money can go into this, or we're going to start lowering the income thresholds. Because right now, if you make more than, I think it's $214,000, you can't even get a Roth if you're married. If you're single, I think it's like 250,000 or somewhere around there. But anyway, the point is the government controls it. With an insurance contract, it's not a government-sponsored plan. It's a private asset that you own between you and a financial institution. So you can build wealth tax-free on the government's playing field, or you can build wealth tax-free in a private playing field. So you just choose which one's best for you. If you think this one, you like the government's the Roth style, then go that direction. Do it. But at least you got something in place that's tax-free.
You diversify your portfolio. You can do a 401k. At least have some form of IUL or insurance-based asset to where you're not going to be all out with the bathwater if one of these things changes. Why do you want to take that risk? You don't need to. And for the one, we can show you math. Like, we could show you how it pays out more. That's why we did the promo with being video. If you go IUL, you're probably going to make up to 40% more while retired than with a competitive plan or a comparative plan. It's just, Exactly. It doesn't make sense. You have all these people complaining about the government, whether if it's a red president or a blue president. Oh, the economy. But you're going to rely on the government for your retirement and your wealth in your family and your savings. It makes no sense. You have a way to privatize that. Utilize it. There's no way of touching it. If it's good enough for every major bank, Pampered Chef, Warren Buffett, Ray Kroc, JCPenney, why isn't it good enough for you? It's like that's a lot of wealthy people who have
many celebrities too.
Isn't that funny how all these wealthy people
if people knew the amount of people that actually own these type of contracts, oh my God, forget it. I got one of these, Oprah Winfrey. Same thing. She owns one of these things. No, these people are not stupid. I mean, and I think the difference is I think, Nathan, what it boils down to is that the herd mentality. It's behavioral finance. Oh, I've never heard of this. How come nobody else is? No, it's been out there. It's just that the wealthiest sector in our nation's economy knows everything about it. You don't know anything about it because it wasn't presented to you. It's the herd mentality. As advisors, it's easier for me to advise something that you've already heard of. You're familiar with it. The Roth IRA, you're familiar with it. There's no fighting that. It's easy. But you got somebody who's successful, makes a lot of money. He expects unconventional advice. The other person who follows the herd, they want to hear the conventional advice. So whatever it is, the bottom line that Nathan and I are trying to get out to you is
You're being
there's two
played.
ways- Yes, there's two ways of generating tax-free revenue. And if you got a tax-deferred account, you better have tax-free revenue, because I'm telling you now, you're making the assumption that you're going to be in a low tax bracket. And that's a pretty big assumption to make. I hope to God that you are in a low tax bracket, but what constitutes a low tax bracket? Low income. So I mean, it's like, who wants to be in a low? You don't want to be in a low. You want to be in the highest tax bracket possible. You just don't want to have to pay it.
Yeah. Here's the thing. Bottom line, we're closing this up now. If you want to trust the government and insurance scares you for whatever reason, that's okay, fine. At least for the love of all that is holy, get the Roth. Because if you're going to go with the government plans, the Roth is your surefire best bet. It's not going to protect you from loss in the future when you retire, and it can be subject to change at any time, courtesy of Uncle Sam. But at least do that for right now. It's the best option if you're too scared of insurance, because.
And look at the numbers. Look at the numbers first before you make a conclusion. Look at those numbers, see them for yourself.
Maybe 50, like Geico, 15 minutes can save you 15% or more on car insurance. 15 minutes with us can make you 20 to 40% more retired and protect your money from the government.
Exactly.
So just take the time. All right, I'm gonna spotlight it again real quick, Brandon. We're gonna wrap this thing up. If you like what we talk about here on the podcast and you want to be able to join our webinar here, you just scan this QR code here. We just talked about a bunch, earn up to 40% more retirement income without increasing your contributions. How do you do that? Well, we're going to tell you this Thursday night at 7 p.m. You can scan that QR code, or you can go to www.mytaxfreeliving.com, where you will be at the register link and you'll be brought to this booking page where you click on Thursday at 7 p.m. Still currently 69 spots left. It was 72 about 2 hours ago, I think.
Oh, okay.
And you can put in your name, date, your email, and your telephone number, and you will be invited directly when the webinar starts. Knowledge is power, folks. If you're not going to heed our warning, at least take our advice. Get where you need to be. It's worth your time. It's worth your money. And nothing's worth more to your money than your time. It's how you spend it. It's how you use it to grow your money. I don't know if I just contradicted myself with that. I'm rolling with it. Confidence is key. It doesn't matter what I say as long as I'm confident. But we're going to wrap it up here today. This has been an explanation of retirement plans for the accumulation and distribution, all the tidbits in betweens and differences between them. Brought to you by Brandon Nieves, proponent of Skyline Financial, and myself, Nathan Bowers. We're a partnership with W.H. Steiner as well. We're going to have the links for my tax-free living for that webinar in the description, as well as Skyline Financial and W.H. Steiner, and how to get a hold of us. So if you like this, please, for the algorithm's sake, so we can reach more folks, help more people, like, share, comment on the video, and do a great, huge favor to us. We appreciate every single bit of interaction we get with these. Follow our Twitch channel. We go live on there. Start asking questions. Can't wait till that happens. But this has been an episode of Beyond Wall Street podcast with Nathan Bowers and Brandon Nieves. Signing off. We'll see you next time.
See you next time.